Today, we're diving into something super important: how we get a sneak peek into a company's financial health, before the year is over. We're talking about those timely, crucial updates that can really make or break a big decision. I mean, think about it for a second. A full business year can feel like forever, right? If you're an investor or maybe a lender, waiting 12 whole months for an annual report can be, well, agonizing. So much can happen. It creates this massive gap of uncertainty, and that means a whole lot of risk for anyone with skin in the game. So, how do we fix that problem? Well, that's where the interim financial report comes in. The best way to think about it is like this: the annual report is the full, comprehensive physical you get once a year. The interim report, that's the vital, timely checkup in between that lets everyone know how things are really going. Okay, so what is it officially? Well, according to the accounting standards, it's pretty simple. It's a financial report that covers any period shorter than a full year, so think a quarter or maybe half a year. And it usually contains a condensed or shortened set of financial statements. Now, these reports aren't just thrown together willy-nilly. Nope, they're governed by a very specific rulebook to make sure everything is consistent and reliable. In India, for example, that rulebook is called Ind AS 34, and these rules are what give us confidence in the numbers. So what's actually inside one of these checkups? Well, the standards lay out the bare minimums. And you'll notice the key word here: condensed. We're talking about shorter versions of the big, important financial statements, plus some key explanatory notes to give context. So why condense? Why not the whole shebang every time? Well, it really comes down to timeliness and cost. The whole point is to focus only on what's new and significant since that last big annual report. It's supposed to be a quick update, not a full repeat of everything we already know. And that's the big question, isn't it? If we're getting less information, how can we really trust it? What stops a company from making one quarter look amazing by, hiding costs in the next one? Well, that brings us to the single most important rule in all of interim reporting. And here it is. This is the golden rule, right from the source. It all boils down to one word: consistency. Whatever accounting policies and methods a company uses for its big year-end report, it has to use the exact same ones for its interim reports, no exceptions. And what this really means is that a single quarter isn't treated like its own little mini-year. Not at all. Instead, everything is measured on a year-to-date basis. Each interim period is just one piece of the bigger puzzle, and it has to fit perfectly into the full year picture. So what does this golden rule actually prevent? Well, it stops companies from playing games with their numbers. It means you can't recognize revenue early just because you know it's coming later in a busier season. And you definitely can't push today's costs into the next quarter just to make this one look more profitable. It's all about a true and fair view, every single time. All right, let's make this super clear with a real-world example. Imagine a company that's highly seasonal. Maybe they sell most of their stuff in the third quarter, but their expenses, like rent and salaries, are pretty steady all year long. Okay, check this out. It's quarter one. The company has 70 crore in sales and 41 crore in actual incurred expenses. Now, the incorrect way on the left is to try and defer or push 16 crore of those expenses to the busier Q3. See how that artificially bumps up their profit to 45 crore? But the correct way, on the right, follows the rule. You recognize all 41 crore of expenses right now. The real profit is 29 crore. That's a huge, huge difference in the story that number tells. And that's the bottom line. That principle of consistency means you can't just move costs around to make the numbers look good. Expenses have to be recognized when they actually happen, period. This is what guarantees that each quarterly report is a reliable snapshot of the company's performance. So we've gotten into the nitty-gritty of the rules, but let's zoom out for a second to the big picture. Why does all this technical detail actually matter so much? It really all comes down to the power of having timely and, most importantly, reliable data. Thanks to these regular checkups, investors and lenders get a much clearer, unfolding story of how a company is doing. It helps them understand how the company generates earnings, how it manages cash, and ultimately, it lets them make smarter, more informed decisions. So the next time you see a headline pop up about a company's quarterly earnings, you'll know exactly what's going on behind the scenes. You'll know those numbers aren't just random, but are governed by this strict rule of consistency, giving you a valuable progress report on their journey toward the full year picture. So what story will you be looking for behind the numbers?